Hey, what's going on everybody? Welcome back to the channel. I'm Waller's Wallet, and in this video, we're gonna go over the differences between a mutual fund, index fund, and ETF, because there's a lot of similarities with those types of investment options. And while we might use those terms interchangeably, they aren't the same thing. Now, I know I'm guilty of doing this, and if you're unsure about the differences between these investment options, then hopefully you'll know the differences by the end of this video and which options you should be investing in. Now, if you want a simple way to help out this channel, consider hitting that thumbs up button. Also, don't forget to subscribe to the channel and turn that bell notification on as well so you don't miss out on future videos. Now, first, let's talk about what's similar between a mutual fund, index fund, and exchange traded fund or ETF. And when you buy these funds, you're buying a piece of all the stocks in that fund instead of just investing in one stock. So for example, VT Sachs has over 3,600 stocks in its funds, and that includes options like Tesla, so you get to own just a sliver of Tesla instead of just buying only Tesla. And because you're buying a piece of all the stocks in that fund, you have much more diversification, which lowers your overall risk. So by investing in these funds, you're better protecting yourself over the long term since you aren't depending on a single asset, which may or may not perform as well. But while they all have these similarities, the differences in them can really guide you to which option could be or the ones you should be using. Now first, let's talk mutual funds. And mutual funds have been around for a long time. And mutual funds are professionally managed funds, which means someone's handling it for you. And mutual fund account managers decide which stocks and the number of stocks that go into these funds, and the number of funds in each mutual fund, it's going to vary. So instead of you personally selecting 30 or 100 different stocks to build out a diversified portfolio, they handle this for you. And they try to pick stocks they think are going to do great, because their goal is not to be the market, their goal is to beat the market. And since it's a person handling this for you, there are higher fees associated with mutual funds compared to index funds or ETFs. And these fees can range, but it's usually around a 1% fee. And that's really not that cheap, because that means it's about $100 for every $10,000 you have invested, in addition to the other fees, and over time, those fees really add up. But in the 70s, Jack Bogle introduced the Vanguard 500 fund, which was the first index fund, and that's really changed how people have invested their money. And while mutual funds are actively managed funds, index funds are passively managed, which means they don't have a person handling every aspect. Basically, you're removing that account manager because the funds selected match a certain index. It can be the Dow Jones or the ever so popular S&P 500 or even others. And index funds are meant to match the market, because historically, those indexes have performed pretty well. I mean, the S&P 500, the average return before accounting for inflation is about 10% annually. And think of it as a roller coaster. Whichever index you select, you buckle yourself in and you're along for the ride. Whether that fund goes up or down, you're along with it. And as long as that index fund performs well, then your investment in that fund is going to perform well. And since index funds are passively managed accounts, they don't require people being involved. So the fees to own an index fund are much lower than that to own a mutual fund. And you can find index funds from Vanguard or Schwab or others for 0.06% or lower for their expense ratios. And Fidelity even offers accounts with no expense ratios. And these lower costs means you have more money working for you in the market, which means more compounding is taking place, and over time, that's more money for you. But with index funds, there could be a minimum investment requirement to get started with them, so you do want to be sure to check that out. Because if a fund has a $5,000 requirement and you only have $2,000, then you wouldn't be eligible to invest in that index fund. And with index funds, you can also set up automatic investments so you can make consistent contributions and put your investments on autopilot, which I find to be a pretty great tool, because people can get busy and you can also forget. So automating this process makes it one less thing you need to think about, and it makes investing just a little bit easier for you. But if index funds are great and they can save you money over a mutual fund, then how do ETFs differ from them? And really, ETFs are pretty close to an index fund, but there are a few key differences. Now, with index funds, you can buy or sell your shares once per day. This usually happens at the end of the market day, so daily fluctuations really have no effect on your purchases or sales because your transaction is going to happen at the end of the day. But with ETFs, they're traded more like a stock, and you can purchase or sell them to your broker all throughout the trading day. And there are a lot of free brokerages out there that charge no fees to make these purchases, and it's very easy to get started. So for example, if you saw VTI drop from $205 a share to $198 a share, you could buy VTI right then and there and lock in that $198 price. But you don't have that ability with index funds. But if you're someone investing for the long term, these daily fluctuations really won't matter in the big picture. You just want to keep going along with your strategy because time in the market is better than trying to time the market. And I think having the ability to trade ETFs at any time could be more distracting if you're someone who's more of an emotional trader and is too focused on the daily ups and downs, or maybe you get too spooked if the market dips. And really, you shouldn't be day trading ETFs to begin with. That's really not the goal if you're long-term investing. In ETFs, you do typically need to buy in whole shares, and with index funds, you don't have to do that. Index funds, you can auto-invest $500 per month or whatever amount you want, and that full amount of money is going to be put to work for you. But if you have to buy in full shares, then you might have cash sitting around until you can add more money and buy more shares of that ETF, meaning you may have money not working for you at that time. But with platforms like M1, they allow the purchase of fractional ETF shares, and even options like the robo-advisor Betterment, who's more limited than M1 in their selections, still offer fractional ETF purchases as part of their software. And if more platforms eventually allow fractional ETF purchases, then only buying in full shares will become less of an issue. Then it leads to the question, which options should you be using to invest in? And when looking options to invest in, I think it really comes down to index funds and ETFs. Mutual funds have higher fees and may not perform as well as ETFs or index funds, and they just seem, I don't want to use the word outdated, but they just seem outdated. I mean, why would you want to pay more money for less of a return? You wouldn't, right? And if you don't want to handle it yourself and you do want help, I mean, you could always use a robo-advisor until you're ready or willing to manage it yourself. And some people don't like robo-advisors, but they do have their place for certain people. There are fees associated with robo-advisors, but those fees are lower than that of a human manager. And they also use tax-efficient funds as well, so I think this could be a nice intermediate for some individuals. Then really, you can't go wrong with either ETFs or index funds. They're both passively managed and they're tax efficient, and you're pretty much just writing a certain index, and historically those indexes go up. So you get the benefit of them with very little work. And I think the biggest draw to index funds over ETFs is that auto investment option and having all your money work for you instead of purchasing whole shares. Now, if we see an increase in institutions or platforms that allow the purchase of fractional ETF shares, then that advantage of auto investing for index funds, they really go away. And ETFs do have a slight tax advantage over index funds as well, but it's really not that huge of a difference. And ETFs do give you more control since you can buy and sell them anytime throughout the trading day instead of just once a day like an index fund. But if the goal is long-term investing, you can buy and hold these and ride out the ups and downs and use dollar cost averaging to increase your portfolio over time. So let me know, are you a fan of mutual funds, index funds, or ETFs? Now, if you're someone looking to build a simple portfolio with great returns, then be sure to check out this video right here where I explain how to make an easy 3-fund portfolio that does just that. And if you want a simple way to support the channel, take a look at the links down in the description below. And if you know anyone that would find this video useful, feel free to share it with them. And I'll see you in the next one. Take care.